is something that's keeping the stock alive in the session.
All right, Vivek, thank you very much for that. That's Adani Enterprises buzzing and buzzing how pretty strong. By the way, the market's also picked up. The Nifty is up 30 points, and that's as good as it gets, at least in today's session so far, because it's not done too much for the bulk of the day. It's up 4, 3 down. So very, very flat for the majority of the day, and there is a bit of a traction which is developing as we speak. 0.15% higher. 1,250 stocks are higher, and you got about almost actually 970 stocks which are lower. So there is enough on both sides. But if you want to see the number of stocks moving on volumes, and that advantage has been for has been with the bulls on the gaining side for many weeks now, and I think that is no different today as well. Prakash, thank you very much. Great to have you with us here on the program as always. Have a good weekend, and we'll see you back next week. Let's welcome in Rajesh Kothari, Managing Director of Alpha Accurate Advisors. Rajesh, good to have you with us here. Welcome back. Thank you very much. So just a quick word, Rajesh, if you've managed to or had a chance to look at how aggregate earnings are progressing well into the second quarter earnings. Because I was looking at some numbers, and at least aggregate earnings are coming off, by some 3, 4, 5%. I'm talking about not growth over 22, but where 23 expectations were and where they are now. What is your sense?
Well, I think, Rakesh, so first of all, thanks, for having me here. I think it is a mixed bag kind of thing, because if you look at, if you do the commodities, then of course, commodities are going to kind of a disappointment in the second quarter. So if you look at, for example, entire the oil pack or entire commodity pack, the metal pack, the steel pack, that are basically going to do the, kind of a more of a downward trend. And that was basically probably expected if you ask my personal view. But if you look at the non-commodity space, for example, banking, most of the large banks have already announced the results. Of course, SBI, everybody's waiting for tomorrow. But till now, the banking has done reasonably well. Look at the advances growth, look at the NII growth, look at the asset quality. By and large, broadly, this sector was expected to contribute maximum to the Nifty incremental growth. So banking is very, very crucial sector for FY23. And there, the results are in line or a little bit better, some surprise here or there. If you look at the automobiles, again, results are broadly in line. The Maruti is one company, of course, which we hold in our portfolio. Results are pretty okay. And, with good guidance going forward, the waiting book is still quite strong. So that numbers are also fine. The capital goods segment is one segment. Again, many companies have reported in this segment. And there also, if you look at the revenue growth, the execution, the order book, broadly, again, these numbers are in line. IT, I think everybody's focusing on next 2 quarters rather than the second quarter. So while the numbers are in line, probably there is a little bit a downward kind of a tone, and that basically makes market a little bit worried. So by and large, X commodities, and that's how always you should look at Nifty earnings. They are broadly in line compared to street estimates.
All right. Hi, Rajesh. I wanted to ask you about this other factor. Everyone's talking about urban India doing well, but rural India is not doing so well. Do you think, we shouldn't focus so much on how the economy is faring? It should be pretty much in line, but there shouldn't be a large disparity. Is that par for the course?
I'm not too sure. I think at times we get really, too much micro-focus, rural, urban. It's very, very difficult to actually now differentiate between rural and urban. And every company has their own definitions, So FMCG company like, for example, Unilever, definition might be completely different than if you talk with HDFC and they are experiencing housing loan disbursement. Or for that matter, South Base, entire banking space. The numbers have been quite good. So I think beyond a point, one should not worry too much about rural versus urban. If you look at the agri growth, the tractors demand growth, reasonably strong numbers even in tractors, what we can see. I think what has changed, Nigel, is where people are spending. It is less to do with rural versus urban. It is more to do with where people want to spend more. So even if you go to the remote place, you will not get a hotel room maybe. So I think that's how the spending patterns are becoming more important rather than which segment one should focus on.
No, absolutely. One of the areas, and we discussed this last time you were on the program, Rajesh, was cement, where you said maybe things will improve. Cement actually is one of the sectors which has seen the maximum earnings downgrade. Do you reckon maybe the bulk of this is behind for that space, Rajesh?
Yeah, I think, as we discussed last time, and if you look at the stock performance, has been quite, we are holding one or two names, actually only one name, and that company is doing absolutely very well. Then the focus is on incremental basis, how is your power cost is moving, and that power cost is moving down. So second quarter was always supposed to be kind of a not that great quarter, but the second half is going to be much stronger. And markets are generally at least 1 or 2 quarters ahead of fundamentals. So, I think probably one needs to be very, very stock specific in cement sector in particular. The raw material, the cost side is going to be in your favor. The volume growth will also come back, and that will lead to the better profitability as we move forward. But as I said, I think it is better to take a bottom-up approach when you talk about cement sector.
Okay, all right. Rajesh, just hold on to that thought. We are getting, Escorts, Kubota's numbers that are coming in there. And on the top line, it's more or less in line. We already had the volumes with us, and, that indicated that the top line will be strong. That's precisely what's happened. However, on the margin front, there appears there's a bit of a disappointment because we were expecting margins in double digits, and it's coming at around 8% odd. And that explains why the stock has come off the high point of the day as we speak. It's moving towards the day's low. Just keep an eye on that. The margin miss is something that the street will not like. We'll have to wait by for the management, to clarify. And how much of a recovery can we see from here on? Well, Rajesh, we briefly spoke about autos. From the tractor theme itself, what would you play? Mahindra & Mahindra has been a big outperformer, unlocking value as well on the EV side. Or do you look at a couple of other names, maybe an Escorts?
No, I think we are more positive on CV cycle and car industry cycle and auto ancillaries. So these are the better bets in our view compared to the tractor segment. We believe that the growth in CV industry as well as growth in car industry will be significantly outpaced the growth in tractor industry. And also, if you look at from the market share perspective, like for example in car segment, so Maruti, we expect a lot of new product launches, and that should lead to improvement in its market share, which it lost to its competition in last 2.5, 3 years. Similarly, in CV space, we own Ashok Leyland, and that company is doing very well. You see the CV recovery and the monthly volumes are in front of you. And the auto ancillary is another space which is very, very interesting. And there we own companies like Minda Industry and Craftsman, and both these companies are be beneficiary of not only domestic recovery but also the opportunity to export to the world markets.
I think the manufacturing space is also, of course, it's capital goods. I think we've discussed in the past. Defense also. The point is, even after the run-up in many of these defense names, valuations, P multiples, 1 year forward basis are still 15, 17 times. In many ways, it's an industry similar to capital goods, right? You get, large ordering sort of bunched up together. Consistency of ordering is not as much in maybe in other industries, maybe even lesser so as compared to capital goods also. What's your view now, Rajesh? Because the moves have been so fast here, defense particularly.
Yeah, I think your observations are broadly right. I think what is more important when you look at the defense versus other capital goods companies, in defense you get the lumpiness of the order, and those order books are for really long time. So it is not that short cycle orders. They are a very longevity of the order is like 10 years execution, 20 years execution, and the earnings growth therefore is not going to be 30-40%. Earnings growth can be 10-12% kind of thing. Whereas if you look at the other capital goods space, the side what we own, of course we also own defense names, but other names like for example what we own is ABB or Cummins or Schaeffler or this kind of companies, they have a short cycle orders, number one. Number two, these all companies are of course debt free. Number three, they have a strong export opportunities because last time we discussed about Europe plus one, which is becoming a new growth engine for many of these companies. So net, we remain, very, very bullish. We talked about this theme almost, I think, 4 quarters back. We're a little bit, early ahead of the game, and that is really rewarding. Most of these companies are probably touching their lifetime highs and now getting consolidating, but a super delivery by this segment. And I think it is just the beginning. Over the next 3 years, we continue to see surprise in order book, surprise in order inflow, surprise in revenue, and also the strong net profit delivery.
Okay, all right, Rajesh, thanks so much for stopping by. And good to hear that you all have been early on a couple of these names like Schaeffler that you said. So good going on that. Thanks so much for joining. Looking forward to chatting up with you rather soon. For the time being, though, we'll slip into a short break. You come back, Nimish is waiting for us on the other side. He'll give us a sneak peek into what's going on in dealing rooms. We'll also get our technical experts who'll be back with us to run us through some closing trades.